take it away. Another edition of Jedi Options.
Yeah, thanks, Matt. So I don't know that I need a better introduction than that, quite honestly. But what I'm gonna call this is credit spreads probability and distance out of the money. So the idea is to give you one additional tool as you analyze your credit spread. And specifically, I'm going to focus on a bull put spread. The reality is, bear calls the other type of credit spread, but most of us do bull puts simply because the market tends to go up, not down. And so that opportunistically, there's a lot more chances to make money with bull puts. As you build your bull put, as you compare one bull put to another, one stock to another, oftentimes, to Matt's earlier point, we focus on how much money I can make, what's my return on investment, what's my probability of profit. But we want to add on this additional layer of analysis to maybe better differentiate what's the best play. And this is I think a simple comparison here, and then I'm going to get into the journal. Remember, let's say we have a $100 stock and I want to enter a bull put spread. Well, effectively what I'm doing is I'm selling out of the money puts, right? That is puts that are below the current stock price, in hopes that those puts stay out of the money, that they stay below the current stock price, that they expire worthless. So effectively, if the stock's at 100 and I build a bull put at 95 and you build a bull put at 85, well, the odds of the stock going below 85 are less than the odds of the stock going below 95. So the 85 bull put has a better probability than the 95. So all else equal, when we're building two different bull put spreads, if one can get a lot further away than the other and give me the same return, I'm more attracted to that one. And so let's say in the first case, maybe I'm able to build a 95-90 bull put. I get a 50-cent credit, which when we sell bull put spreads, $5 wide, 50 cents translates to kind of an 11% return, pretty much the lower bound of what we want. So I get a 50-cent credit. Let's say the delta is 20. So my probability of winning or probability of profit's 80%. Well, if I have another stock that's trading for $100 and I'm able to do a 90-95 bull put and get 90-85 bull put and get 50-cent credit, and maybe it has a delta of 10, my probability of profit's 90%, right? So you say, oh, okay, well, you get further out of the money, you get the same payment, but better probability. Yeah, go with the second one for sure. But what if the delta was the same, right? And the probability is the same. Like, how do you know? I mean, in this case, I guess you might say, oh, we'll definitely do the 90 because you're $10 out of the money. Here, you're only $5 out of the money. Well, the problem is distance out of the money really is not the best way to look at it, because maybe the first stock is less volatile than the second stock. Okay. So looking at distance out of the money is okay, but not perfect. It would be better if you adjust for the volatility of that particular stock. Okay. Because $10 out of the money may be way too close for a really volatile stock, and $5 out of the money may be plenty far away for a non-volatile stock. So the beautiful thing about using ATR as your metric to gauge distance out of the money is it adjusts stock by stock, right? So it's sensitive to volatility and thus gives you a better read. So that's kind of the thought. Now you probably have some unanswered questions here. Let me use the Tackle Theta spreadsheet and compare a couple different bull put spreads, and I'll show you the ATR and how that might help me make a better decision. Okay. So at Tackle Trading, we've created a spreadsheet that allows you to look at the performance metrics of various spread strategies and make a more informed decision. This right here is the one on the bull put spread. And I've already picked 3 stocks that I'd like to take a look at. DVN, FCX, and Walmart. So I'm going to fill this out. We're going to compare contrast here. See if we can use this ATR buffer, this distance out of the money, to get a better idea of maybe which one of these has the better trade. So let's start with DVN. This is an energy stock. And these aren't necessarily perfect setups right now, but they're interesting trends and interesting stocks that have different types of characteristics that I think make bull puts feasible. DVN obviously benefiting from the strength in energy. This is a $48.12 stock. So let me actually do this. So I got $48.12. The ATR, this is an indicator you can add. It tells you how much the stock moves per day on average. So DVN moving about $1.95 a day. I'm going to be using February options on this. February options, I believe, are 44 days out right now. Yeah, 44 days out. And I'm going to build a bull put using maybe a 20 delta. So I'm going to sell the 42 and I'm going to buy the 37 to build a $5 wide bull put and get 69 cents credit. So the short strike is 42. The short option delta is 20. The long option strike is 37. Okay. The net credit, 69 cents. The buying power effect, $4.31. Okay. And you can do a whole number. I could have said 69 and 431. They just have to be consistent. So it's either per share or per dollar. Pause. Couple of numbers that stick out to me. Number one, the return on investment's 11%, which is great. Okay. That's per 30 days. This being more of a 44-day trade. Over the 44 days, it's actually about a 16% return, which is plenty. Okay. The ATR buffer is 3.1. So this 42 strike price is about $6 out of the money, or about 3 ATRs. Okay, about 3 ATRs over a 44-day time frame. So think about that. If I can get 3 ATRs out of the money from 48 all the way down to 42, okay, think about what that implies about my breathing room, right? My profit range, versus if I could do maybe another trade with the same delta, but get 4 ATRs out of the money or 5 ATRs out of the money. If I can get further out of the money for a similar probability, I'm more attracted to that. And quite honestly, you might say, well, it looks like you could go further out of the money in this one. I mean, you got a 16% return. You could probably get a little bit less than that if you wanted to. Maybe you go further out of the money. And in fact, I actually want to try that. And then we're going to go build one on FCX. So I'm going to go to the 41 strike, build a 41.36 for 58 cents. I'm just curious here. 40.35. Yeah, you couldn't go any further than that. So 41.36 looks like about it. You're going to get 59 cents for 41.36. And the delta on that was 17. Credit was 59 cents. So buying power is 441. All right, a little bit different here. So you can see ROI now slightly below 10% if you're looking on a 30-day basis, 13% for the whole 44 days. But the ATR buffer now almost 4 ATRs over the 44-day time frame. If you look at it per 30 days, it's about 2.5. Now, that alone tells you something, but I want to compare it to a bull put on FCX. See how they line up. So FCX, talked about FCX today with this pop in copper. This is at actually copper didn't pop with the pop in basic materials. 42.87 is the share price. This has an ATR of $1.21. $1.21. I'm again going to use February options to build my trade. I'm going to go 44 days to expiration. Now I need this to be apples to apples. So I need to go sell a bull put with a delta around 17. Okay, just so that it's similar to what I just built. So on the delta column here, it looks like I can go to about a 37 strike. So let's sell that. I'm going to buy a 32 so that it's $5 wide. And I get about, I'm going to round it up to 50 cents to make the math easy. So get 50 cents. Again, it has 17 delta if I round up. Now, the going back and forth can take a little bit of time to finding everything, but you'll get quicker as you go. So 37, 32. So I sold the 37 put, had a 17 delta, bought the 32. Now the ATR buffer on this, I'm almost 5 ATRs away. Almost 5 ATRs away, which is interesting. 50 cents on 450. All right, so now let's compare these two. First of all, which one do I like better? Which one do I like better? Well, I like that DVN gives me a little bit better return, but it's only 3.7 ATRs away over that 44-day time frame. FCX at 4.9 ATR, 11%. You know, if it gave me the same ROI, but another ATR away, it'd be a slam dunk. I take FCX over DVN because I'm getting a bigger buffer, right? As is, you give up about 2%. This almost seems fair. It almost seems like the market's like, look, I'm going to give you a little more room out of the money so you don't get as good of an ROI. That's often going to be the case. It's often going to be the case. But let me throw on one more because Walmart is a boring stock. I'm just curious to see what the ATR looks like if we build a similar trade on Walmart. Okay. And I don't know if we're going to get a $5 wide here, but let's take a quick look. And I'm actually going to just put this on the other screen so I can go a little bit quicker here. So Walmart is at $144.78. It has an ATR of 238. I'm going to build a February trade 44 days out. I'm going to sell around a 17 delta, try to make this apples to apples. So I can get an 18 delta. So 135, 130, close enough. 135, it's an 18 delta, bought the 130, and I'm getting 56 cents. So my cost is 444. Okay, take a look at Walmart. So Walmart ATR buffer for the 44 days is 4 ATRs, a little more than DVN, little less than FCX. ROI is actually comparable here. Man, Matt, we've picked 3 stocks. I don't know that I can categorically make the call based on just the ATR buffer being the added element. I'm interested to get your take in lining these 3 guys up. What do you think?
When I'm looking at these, if I'm just selecting these 3, right? If you wanted to show a radical example, we could have just, grabbed like BABA and show a little bit of a more radicalized example. But I like these debates, Ty, because you're looking at 3 very similar examples when you're comparing ROI, ROID versus, ATR ranges. But what stands out to me, because when you look at the ATR buffer here, the standard ATR buffer is calculated based on a 30-day number. Obviously, we have 44 days till expiration in this example, and so that's why you see the 2 numbers, and FCX 4.9 versus 3.3, for example. John, let me just ask you a question. How many times, the amount of credit spreads you have sold in your career is a daunting number. Massive number, correct? More than you could possibly count. How many times in those credit spreads did you say, man, I just wish I had another dollar of range? I just wish I had.
Listen, I always wish
how many times, right? How many times? So when you think about the difference between, say 3.3 versus 2.8, you're like, oh, it's just 0.5. That's nothing. Well, it's also 25% more range. is what it is. If you think about it like that, it's actually a fairly substantial deal when you're talking about the difference between a standardized ATR buffer of 2.5 on Devon and 3.3 on FCX. That might seem like a little small number to most traders. To me, that's a massive, significant difference in the quality of that setup versus saying, again, I'm just taking into account ATR, not anything else right now. But that to me is a tiebreaker scenario, and it's not even close. If you're getting an additional 0.8 ATR buffer and the other metrics are fairly similar, which they are, it's not even close to me. That's an automated one because that gives you an entire ATR, an entire day, 30% more range that you are selling on FCX than you're selling on DVN, and you're selling the exact same delta. You're selling the exact same delta, but on FCX, you're getting a much more significant range. And I would say it's significant more when you're talking 20, 30% more range on FCX than you are Devon. That's the difference between a successful trade and an unsuccessful trade, in my opinion. So FCX kind of stands out in those two to me. FCX would be the winner here.
Well, and I think to bring this home, you're 37 on FCX versus 41 on DVN. So it should show up visually too when you look at distance out of the money. You should see the added amount of room, right? So 41 essentially, that's your bull put on DVN in terms of distance out of the money, and then FCX was it 37 on FCX, right? So FCX, your short strike is down here.
Well, and both of them are quality setups, given the fact that they would both have to violate a lot of support and go against kind of trend analysis as well. You got to like them both. I'm just saying, if you're looking at a tiebreaker, and that's what the spreadsheet really does, is it breaks ties. If you're looking at a tiebreaker scenario, FCX stands out to me.
I dig it.
Yeah.
So, yeah, great. So you can use the tool. ATR, just again, an added element to maybe to Matt's comment there. Make the tiebreaker. If you can only do one and you're trying to really dig into the numbers, I think that's an interesting perspective.
Yeah. I love ATR ranges. It just helps you understand how much cushion you really have on credit spreads. And the spreadsheet, I feel, does a wonderful job in helping us highlight, as traders, different strategies, same strategies, different stocks, really comparing which one is a better setup. Here, I would shade to FCX, but again, Devon looks pretty decent as well. Tyler, thank you so much for another wonderful edition of Jedi Options on understanding the ATR buffer and ranges in general when it comes to selling credit spreads.